Good morning, America. My name is Richard Ciuzio, and I am a loan officer with Hudson United Mortgage, licensed in the states of New York, New Jersey, Connecticut, and Florida. I'm a residential officer. I live in Yonkers, and I am based out of Elmsford. So if you have any questions, if you're a first-time home buyer, if you're looking to do a refinance, save some money on your monthly mortgage or lower your rate and term, give me a call, free consultation. You can reach me at area code 321-634-2552, or you can send me an email to first name.last name at hudsonunited.com. So that's richard.cuzio@hudsonunited.com. I want to welcome and thank everybody for tuning in to the Phoenix National Network. If you haven't been with us before, we have apps on the Amazon and Roku devices. You can download them from your Play Store or your iPhone app. And we also have a YouTube channel, Facebook page as well. So feel free to join us wherever you feel most comfortable watching. So today, I want to talk to you a little bit about financial. It's our finance month. And I would like to educate all of you potential buyers and borrowers on whether or not you think you're ready to buy a home. That's my title today. Are you financially ready to buy a home? All right. So I'm going to go over some things in detail here. And, obviously the first step in buying a home is to get pre-approved. That is the very first step. What can you qualify for? Let's see. All right. What is a pre-approval? Pre-approval is it's a conditional commitment to lend, whether it's provided to you by a loan officer, a banker, or a loan originator. It's them doing their due diligence on your behalf and properly vetting your income, your assets, and your credit. Somebody has done and performed an income analysis on you and has done a credit check. It's run your credit, checked your background. It's accounted for all of your monthly liabilities, and we actually have a credit score. Everything taken into account. That's how we figure out whether or not and what we can qualify you for as a potential borrower. You have been officially pre-approved. A pre-qual or a pre-qualification is a little bit different. What is a pre-qualification? Something I don't do. I prefer to properly vet my clients. However, a pre-qual, some institutions do. It's an approval based on stated income and numbers. If somebody is taking your word that you are making this much money, you have this much money in the bank, and your credit score is about this. It's just verbal verification. You have not been properly vetted, and the person or institution that is issuing this pre-qual, what they're doing is, like I said, they're taking your word on what you say. So personally, I vet all my borrowers. It gives you peace of mind. It gives me peace of mind. So wouldn't you rather know what you exactly or roundabout what you can qualify for instead of just guessing, getting your hopes up, and then only to find out that you don't qualify? So I properly vet all of my clients, all of my borrowers. It's the right thing to do. So what's next in the step? All right. So after you get pre-approved, you're going to go home shopping. You're going to go and potentially find your home. You're going to go to open houses. You're going to get with your licensed real estate agent. You're going to tour different geographical parts of the state. And you're going to check out different homes. You're going to make a bid on a home that you like. And God willing, you get an accepted offer. All right. The next step after you get an accepted offer is to do a home inspection. You want to make sure your home is tip top. You want to make sure that everything's working. Plumbing, electrical, there's no leaks in the walls. The foundation is safe. Safeguards are implemented. Whether it's railing, roofing, gutters, etc., air conditioning, if you have it. You want to make sure everything's tip top. All right. You don't want to buy a piece of junk unless you know it's a piece of junk going into it. And that's a different story altogether. However, if you're looking for a home to suit your family, you want to make sure it's safe and structurally sound. So the home inspection, on average, a home inspection is going to cost you anywhere between $300 and $500, depending on the home, depending on the location, how far they have to travel, and the inspector himself. This is paid outside your mortgage. All right. It's not included in the closing costs. All right. So plan on that. That's $500, give or take. I'm rounding up, but it is different for every home inspector. All right. And then what happens next? Your inspection report comes back. Let's just say it comes back clean and clear, and you want to proceed with the purchase of the house. You need a purchase contract. And who draws up purchase contracts? In the state of New York, you're going to need your real estate attorney and your real estate realtors to draw up these contracts. You need, on a purchase in the state of New York, you are legally obligated to have a real estate attorney. All right. It's good to have one anyways, because they're representing you. They're here to work for you. They're going to give you peace of mind that your purchase is going to go smoothly, and it's just going to drastically lower the possibility that you're going to be hit with any unexpected legal problems. All right. This is also something that is paid through the proceeds of the loan. Sometimes you might have to put a small deposit up ahead of time, or some attorneys might make you pay up front. It all depends. It is paid outside the loan, though. You could, on a good attorney, on average, it's going to run you $1,000 to $2,000. But that's also going to vary on depending on what kind of transaction it is. If it's more tedious, or if it's more of a luxurious real estate transaction, the more money it's going to cost you. But on average, you're probably looking anywhere between $1,000 and $2,000. All right. So do your due diligence, get a feel for a good attorney, and once you have, once you find one and you have a good gut feeling about them, go ahead and you utilize their services. If you don't know anybody, we can always recommend someone to you too that you feel comfortable with, that we feel comfortable with, and that ones that we've worked with before. We know their methods, we work good with them, that we work on a daily basis. So just bear in mind that's another expense out of pocket that you're going to have to pay. Next, so what happens next? Once you find your attorney, all right, once you choose a new attorney, you're going to sign your client agreement disclosure and the purchase contract. So once you sign your purchase contract, right, it depends on what state, every state varies, but you're going to have to put down your down payment. How much did you agree on as a down payment? Was it 5%, 10%, 11, 12, 20, 25, 30? Whatever the contract offer was. Can you put more down at closing? You can, if you want to lower your payment. However, you are obligated to put down that down payment at contract signing, usually a certain percentage up front, sometimes half now, half later, or 10% now and 90% at closing. Either way, you're going to have to bring something to that contract signing, and it's going to be held in escrow until the loan funds. Some states require a minimum down payment at signing, like Connecticut will require 1% at contract signing. And then if you're doing like a 10% down payment, that other 9%, you have like 10 business days or 10 calendar days to get the rest of the down payment to the attorney. So some of these fees do have a time frame. So, excuse me, on a $500,000 home, if you want to put down 10%, which is probably the average price, I would say, Westchester, Rockland County, if you really want a nice, decent home, single family residence, you're going to be looking no less than 4, but 5 or higher is going to be a good number. But for argument's sake, for the purposes of this discussion in this segment, I'm going with 500,000. And if you want to put 10% down, that down payment alone is $50,000. 10% of 500,000 is 50,000. So just between those three fees, you're up to, $52,500. Okay. If you put 5% down, obviously it's half, so you're only going to put 25,000, but you're still up to 27,500 or 52,500, depending on which way you want to go. The minimum down payment. So, by the way, I want to just reiterate this. It's better to have the strongest buyer profile, especially in today's market, because it is a seller's market. There are bidding wars out there, and if you get into a bidding war, they're going to go with highest and best offer. If there's not a bidding war, you might be able to utilize a 5 or 10% down payment, but you do want to utilize and create the best, strongest buyer profile that you can possibly have. And if you can afford to put a little bit more of a down payment on, so do it. However, the minimum down payment on any conforming or conventional loan is 5%. And why is that? Okay, because any bank or lender on a conventional loan will finance up to 95% of the appraised value, not the purchase price, but the appraised value. Okay, so 95% plus 5 equals 100. So that's why you can put the minimum down payment on a conventional loan as a 5% down payment. Unless you qualify for a first-time home buyer product, and it's 3%, but there's income restrictions and geographical locations and a whole bunch of other stuff that we can get into in another time. So now, unlike some banking institutions or lenders, they may require certain fees up front. Which ones? I cannot say because I don't work for them. I work at Hudson United, and I can only attest that Hudson United, we don't ask for any fees up front. Hudson gets paid, Hudson United, we get paid, I get paid through the lender when the loan funds. So all of the parties that are involved, attorneys, title, everything that I'm about to go over, we all get paid through the funding of the loan and only when the loan funds. Therefore, my consultations are free. My services are at no cost to you. And I don't get paid until your loan is closed and funded. So I'm here to help night or day. If you have any questions, you know how to get a hold of me. The first thing I'm going to do, I'm going to put up a screen presentation in just a moment. I'm going to go over with you line by line on an Excel spreadsheet that we've created, all the fees that you can expect. It's a little bit of education that are included with your closing costs from various sources: title agencies, credit agencies, appraisal, insurance, escrow, taxes, et cetera, et cetera. So bear with me here. I'm going to just minimize my screen. All right. And give me 1 second while this loads. Okay. Phil, are we good?
Yep.
Thank you. All right, guys. So if you look, this scenario here is based on a 30-year conventional scenario with based on today's market rates on this purchase price with a FICO score, which is your credit score higher than 740 or higher. Okay. This is the 500,000 that I was telling you about with your 10% down payment, which makes your loan, AKA what is going to be financed by the bank, at 450,000 at a 2.875% interest rate. On average, that's pretty much what the market's at today, and give maybe a little bit lower. I think it's like 2.77, but for argument's sake, I'm just using 2.875. 360 is your term. That's 30 years, 12 months, 360 months is 30 years. That's why. So your first mortgage, your principal and interest payment at 2.875% over 30 years is $1,867.02. Estimated insurance about $100, could be more, could be less, depends on your policy. Taxes, your annual property taxes, school taxes, city or town taxes, divided by 12. If this based on this number, that means your taxes are about $12,000 a year. Realistically, in Westchester County, you're probably going to be looking anywhere between $12,000 and $18,000 a year on average, depending on size of your home and, like I said, your geographic location. But for argument's sake, I am doing 1,000, just keeping it simple. And mortgage insurance, PMI, private mortgage insurance that ensures the lender is going to get paid in case your house is foreclosed upon. It's only protecting the lender. It doesn't do you any good. The reason you have to pay this is because we're putting a 10% down payment. Anything less than 20, you are required to pay PMI. It is based, the calculation is different for every loan. It's based on LTV, FICO score, and a few other factors as well. So this would be your total housing payment based on this scenario, 3192 and a couple of pennies. All right. Over 30 years, it is fixed. It is your principal and interest is not going to change. The only things that might change over time are going to be if your insurance premium goes up or if your annual property taxes go up or down. All right. Also, your PMI will cease to exist once your loan to value reaches 78%. Based on this scenario, your loan to value is at 90% because you put 10% down. That means you have 10% equity in your home. So when your loan to value reaches 20 or 78% and you have 22% equity in your home, this $225 is going to go right back in your pocket on your very next payment. On an amortization on average, it's probably about 6 to 8 years. If you do a 5% down payment, it'd probably be a little less since you're starting out at 10, but your monthly payment will be $225 less. All right. So this gray box here, we're going to move down, is services you cannot shop for. Okay. Home buyer counseling, that's only for like first time home buyer products. Discount points or lender credit. You can have the option to, if you want to go get a lower interest rate, you can opt to pay for like 1/8 of a point or 1/4 of a point, 1/2 a point, or a full point, whatever you want. If you want to pay that money and get a lower interest rate, if it's worth it, if the pricing's right, you can do so. On the flip side of that, an opposite of a point is called a lender credit. A lender credit is, instead of your interest rate going down, you're opting to take maybe a little bit higher of an interest rate by 1/8 or 1/4% to help offset some of your closing costs. They will credit you a certain amount of dollars towards your closing costs, and you can save some money in the long run. What's the downside to that? You're paying a higher interest rate over 30 years and a little bit higher of a monthly payment. But if you're in a bind, it is a good way to help offset closing costs, especially if something came up, because you never know. Everybody's situation is different. Everybody's loan is different. All right. Now you have your application and underwriting fee. This fee is from the bank, not Hudson. This is the actual lender or the bank. They're going to charge you a fee for underwriting and submitting the application with them, especially the underwriting fee. It could be a little higher, could be a little less. It's anywhere between 1,000 and 13, depending on what lender we go with. But then you have another fee, not Hudson. This is the appraisal. It's going to be from the appraisal management company. You're going to have to get an appraisal on a house, plain and simple. Sometimes you can get away with not having one, depending on loan to value, if you've had one done like on a refinance within the past couple of years. But most times, especially on purchases, you're going to have to pay for the appraisal. On average, it's going to run you about $550. Usually it's a one-time charge to the credit card. What will happen is they'll charge your credit card, and at the end of the day, when you're closing, on your closing disclosure, it will read as an expense paid in advance by the borrower. So it'll come off of your total closing costs and be deducted because you've already paid it on the side. Now you've got your credit report fee. This is based on one person, estimated 40. It's probably like $36. But if you have 2 people on the application, then it goes up, 3 people, 4 people, so on and so forth. Tax service. This is for escrow. It's from the title company to do to help with the escrow. They're going to check to see if you're a flood certification, see if you're in a flood area. And then you've got bank attorney. All right. Now, bear in mind, all of these costs, these are going to be rolled in. These are going to be all part of your total closing costs down here at the bottom, which I'll get to. All right. But these are the services you cannot shop for. Bank attorney. This is the attorney who's going to do the bank work. This is not your real estate attorney. Does your real estate attorney do the bank work as well? Yes, sometimes they do. Are there real estate attorneys out there that do not do bank work? Yes, there are. It's easier if you kill 2 birds with one stone, so to speak. But on average, you're probably going to be looking at it around $1,250 added in there. to have the bank work done to balance everything between title, the lender, and whoever at the end of the day to make sure all the figures match and everybody gets paid and the loan funds and closes. All right. Now you've got the blue fees you can shop for. Okay. Your attorney, you can shop, you can pick out your real estate attorney. I have 1,500 here. Could be, like I said, anywhere between $1,000 and $2,000. I just put 1,500. This is paid outside the loan. It's not going to be included, but I included it in here anyways to know, so you can be prepared with what to expect down the road. I want you to be as financially prepared as possible when you're looking to buy a home. Now you've got title fees, bankruptcy. These include bankruptcy searches, lien searches, mechanic liens, Patriot Act, all that stuff that title does. All right. So it's about $1,200, could be more, could be less. Now you've got a property land survey, probably around $700, $800. What is your land survey? Tells you the outline of your property. When you buy a home, don't you want to know where your property line ends? What if you want to build a stone wall or a moat or something cool like that, or a fence? You don't want to put it in your neighbor's yard and piss him or her off. You want to make sure that you know where your property line ends, so you're not overstepping your boundaries. It's good to have. If you haven't had one done recently, it would be a good idea to do one. Sometimes the sellers do the property land survey ahead of time and provide it to the borrower. However, if not, and you want it, you can get it. I recently did a loan where the survey was just updated, but the last one done was from 1950. That was 70 years ago. Things have probably changed since then. I probably would have wanted a land survey done on my deal. All right. Just for peace of mind too. So now you've got title insurance, owner's insurance, and title insurance for the lender. What is title insurance? Okay. Well, when a property is financed, it's bought or sold, whatever, a record of that transaction is generally filed in the public archives. So records of other events that may affect the ownership of a property, like liens or levies, those are also archived. All right. So when you buy title insurance for a property, a title company searches for these records to find and remedy, if necessary or possible, the several types of ownership issues. First, the title company searches public records to determine the property's ownership status. They want to make sure there's a CO on the property, certificate of occupancy. They want to make sure that the person you're buying it from is the person who actually owns the property. All right. After this search, the underwriter is going to determine the insurability of the title. If you take out a mortgage when you buy your property, the lender is going to require a loan policy of title insurance. This protects the lender's interest in your property until your loan is paid or refinanced. On the other hand, an owner's policy of title insurance ensures your ownership rights to that property. So even though you only pay for this once during the loan, your coverage is going to last as long as you own the home. Okay. So that's what title insurance is. Now you've got endorsements and recording mortgage of the deed. Recording the mortgage of the deed, that's very important because it's going to be recorded with the county and the city. Your names are going to go on the deed. Mr. and Mrs. Jane and John Doe going to be homeowners. It's going to get recorded. It's got to get recorded. It's usually about a $400 fee. Oh, and then the infamous dun 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 state mortgage tax. Gotta love New York. New York State mortgage tax. It varies by county. Okay. In Westchester County, there is a 1.3% state mortgage tax. Yonkers, Peekskill, and Mount Vernon have city tax. Woohoo! So now you're paying an extra. I think Yonkers is 1.5% on city tax as well, plus your state mortgage tax. So be prepared for state mortgage tax. Is there mortgage tax in Jersey, Connecticut, Florida, Colorado? No, they vary by state. New York happens to be one of the ones that you're going to have to pay state mortgage tax. So on this transaction, you're looking at about approximately 4,700 added to your closing costs because of New York state mortgage tax. Now you have in your yellow, so these are your total closing costs. Estimated everything here from top to bottom, get about $14,780. Those are just bank costs, everything included for the bank. Okay, under appraisal, underwriting, credit report, attorney fees, title insurance, state mortgage tax, and recording of your deed plus your survey, give or take. Now, these are not set in stone. This is not a Bible. It's just a good resource and tool to utilize to prepare yourself and educate yourself financially when you're buying a home. Everything comes into play. Loan to value, down payment, purchase price, credit score. Is it a condo? Is it a co-op? Is it a single family? Is it a multifamily? Is it an investment? Is it a second home? All of these factors will change these numbers. So every loan is different. Every scenario is unique. Now you have your yellows, which are your prepaids. All right, what are your prepaids? Your homeowners insurance is one of them. You're going to have homeowners insurance. Just like you have car insurance, you're going to have homeowners insurance. Depending on your policy and your premium, you're looking at 1 year's paid in advance at about $1,200. It's $100 a month times 12 months in a year. It's $1,200. You pay that in advance, and you provide the underwriter and processor with a paid receipt. It comes off your closing costs at the end, kind of like the appraisal. But this is a fee that you're going to have to pay. And then you've got your taxes, your escrows. All right, what are escrows? Escrow is an account where the lender will pay your quarterly property and school taxes on your behalf when they are due through your mortgage. Based on this scenario, this property has $12,000 a year in taxes because it's $1,000 a month. So at $12,000 a year, that's why this number is here. In the state of New York, you have to pay, actually pretty much anywhere, you have to satisfy whatever taxes are due within a 60-day period. So that's 2 months worth of taxes. Anything that's due, you're going to have to satisfy. And the other 10 months will go into an escrow account. So when your quarterly taxes are due the next time around, like let's say if you close October 1st, you're satisfying whatever taxes are due between October 1st and December 1st. So when your quarterly taxes or your school taxes are due in January, the lender that we've chosen, that you've chosen, are going to pay your quarterly taxes when they're due through your mortgage. Meanwhile, you're making your monthly mortgage payment and replenishing that money into the escrow account. That is what escrow does. You are escrowing and paying your taxes and insurance through your mortgage. Do you have to escrow? No, you do not. But in order to waive your escrows, you have to put a minimum of 10% down. All right. So based on this scenario, they would not have to. What are the benefits to doing that? You're going to lower your closing costs by approximately $10,000 based on this scenario because you're not escrowing $10,000 worth of taxes into an account. What's the downside? Now you got to remember to pay your taxes on time, when they're due. You got to know when they're due, how much is due, and when to pay them, so you don't get slapped with a late fee by the city or the county. And then same thing with your insurance. You'll have to pay that when your premium is due as well. Some people like the peace of mind. Some people don't like to give the county or the city or Uncle Sam a single penny until they absolutely necessarily have to. It's a personal choice, but only if you put 10% down or more. So that's what the escrows are. So based on this, 1 year's worth of taxes and insurance is going to cost you approximately, plus your prepaid interest. I'm sorry, your prepaid interest are your, it's however many days between the end of the month and you're closing. So let's say you close on October 15th. Now you're paying from October 16th to October 31st prepaid interest, that extra month, because you were the rest of the month, because you were going to, you're not going to have a payment for that first month. You close October, you're not going to have a payment till December 1st, plain and simple. All right. So that's your prepaid interest. All of these are your escrows, estimated at $13,885. Add them all together, plus your down payment. On this scenario, total cash to close, $78,665. Boom. Can it be a little less? Yeah, it can be. You can find a place that doesn't have $12,000 in taxes. Maybe you're in Connecticut. Maybe your taxes are only $6,000 or $7,000. Maybe you don't want to escrow. So you're saving, $10,000 there on this scenario. These are, maybe there's no mortgage tax in Connecticut, Jersey, Florida, Colorado. Those are only states I know that don't have mortgage tax, because I'm not licensed really anywhere else. So I said those, but if you go to Jersey or Connecticut, you're saving $5,000 on mortgage tax alone. So yeah, these could be a lot lower. They could be a lot lower with a co-op. Co-op, you don't own the property. There's no title. There's no taxes. Everything's included in maintenance. So you're paying maybe $6,000 in total closing costs. Condos are going to be cheaper too than single family. So there are a lot of variants here where you can save money on closing costs. It all depends on what option is best for you, what suits you, what suits your family, and what you're most comfortable with. So I'm going to open it up. That's really all I have. Like I said, every loan is different. These are the basics. So please don't consider it the Bible or set in stone. It is just a good tool and guidance to make sure you and everybody is financially sound and prepared on what to expect down the line. Are there any questions? If there's any questions, Phil, you got anything? Anybody type anything? Do you have anything?
Listen, man, that was a phenomenal amount of information. I'm sure somebody out there, they were like, okay, I need to talk to Ricky because I'm not even sure where I am in my process. So that was great, man. Thank you so much. That was
My
awesome.
pleasure.
Awesome stuff. Awesome stuff. The taxes. That's all I could hear. Taxes.
That's all everybody hears. Oh, we got to pay that. We got to pay that.
Who made these taxes anyway? I mean,
there's no taxation without representation, my friend.
Well, that's true. I guess, yeah, somebody's got to pay it, right?
That's right.
So I thought that mortgages, when you have a mortgage, it pays. It's like almost like you can pay your taxes and insurance through your mortgage.
That would be the escrow. That would be, you are escrowing your you don't have to. It is an option to the borrower. However, like I was saying, if you're doing less than 10%, you are obligated. You cannot waive your escrows if you put less than a 10% down payment. So they will be included in your mortgage. However, 10% or more, you can, with the lender, waive those escrows and pay them outside your mortgage. So for instance, on the scenario that I just did, instead of the $3,192 a month, now their mortgage is $1,867.
Got you.
Right, because you're only paying your principal and interest. You're not paying your insurance. You already paid years in advance. I'm not going to pay that until 2022.
Right.
And then my taxes, I paid to my 2 months. Okay, so now I closed in October. I paid through December. I'm not paying till January, but you got to make sure you have that money set aside come January.
Right. So that when it hits.
Right. Like I said, some people don't want the headache. They don't want to remember to have to pay their taxes. They'd rather pay it and escrow it through their mortgage. What happens to that money that's in the escrow account when my account closes? Very good question. You get whatever's in there refunded back to you within 30 days.
Get out.
No, it's your money. The loan is closed. So if you've paid off your mortgage, you don't have an obligation with the bank anymore, and they don't have an obligation to pay your taxes on your behalf. So you're going to get that money back. And it's kind of like when you're doing a refund. you're going from one, or a refund, I'm sorry, a refinance.
Right.
You're going from one lender to another. So you're
Mhm.
canceling and closing out an escrow account with that current lender that you have. Let's say you have Quicken, right?
Right. Right.
You're
Right. Right.
closing out your Quicken account and you're moving to Mr. Cooper. Now you have to establish a new escrow account with Mr. Cooper.
Gotcha.
Meanwhile, that
Right.
money that's sitting in Quicken's account gets refunded back to you. So it's kind of like a wash when you're doing a refinance. However, you
Right.
do get that money back. It's your money.
So can you move that money? Let's say that in that same scenario,
Mhm.
can you move that money? Can you move it from one escrow to another escrow?
It has to be with the same lender.
Okay.
It has to be with the same lender. You can usually do that when you do a SEMA. What is a SEMA? It's a consolidation, extension, and modification agreement, where what you're doing is you're doing a refinance on your primary residence or whatever it may be. You do a SEMA. SEMAs are only known, people don't in Jersey and Connecticut and Florida, they don't know what SEMA is because there's
Mhm.
no state mortgage tax. A
Right.
SEMA prevents you from paying your state mortgage tax a second time around because you did it the first time when you bought your house. All right. So if I'm going from Quicken and I'm doing another loan with Quicken, same refinance, I can do a SEMA and they can just keep that escrow account that they currently have and transfer it over to the new loan with inside Quicken.
Perfect.
Mhm.
That's perfect. Thanks for
Yes.
answering that question.
You're welcome.
Because that was one that I was really kind of like, how do you
It's got to
memorize
be.
all these abbreviations?
It takes time, dude. It really does. It really does. I start making them up just for fun anymore. I'm like, yeah, I feel like Wheel of Fortune at times. RSTLNE. Vanna, give me some more letters, please, and consonants. Thank you.
Oh man, I see. I mean, that's why we need to have the people that know what they're talking about. Because if I was just trying to do this on my own, and I saw all these abbreviations on a sheet, I'd be like, I'll just sign it, and then we can interpret this later. How's that?
Oh man, I'm telling you.
So is it every state that you need to have? This is a question. Is it every state that you need to have an attorney representing you at the table, or
It would be good to have um, an
that?
attorney represent you. Is it
Mm,
required for every transaction? No, it's not. Purchases in some states like New York require it.
mhm,
However, like in Jersey, on the purchase transactions, you're going to have an attorney. However,
mhm,
the title company does the bank work. So you don't need a bank attorney to do the ledgering and balancing. You're going to, the title company does it. Florida has the title company. Connecticut, the title
mhm,
company does it.
mhm.
So every state is different. Colorado, it's title company. You don't need an attorney.
New England. I heard New England is very different
No,
in
I
how they
don't,
do.
I don't know about Massachusetts or
Right.
Vermont or any of those, states, Maine, New Hampshire, but I know it's very pretty up there.
Yeah, hey, that's what I heard. It's
especially
really
in a,
nice.
especially in a couple months, especially in a month or two when the leaves start changing again.
Absolutely, absolutely, man. My last question for you is this, right? How what role do you play along this whole process? Like, do you actually guide people? You help to guide people through this? And how do they reach you in order to do that?
So what I do is I am there from start to finish. I'm there from pre-approval to closing. I show up at my closings, or at least I try to make most of them. Sometimes there's a conflict of schedule and I'm not able to do so. However, I do like to go to all my closings. I like to meet the clients in person if I haven't met them already. I am there from start to finish. I'm here to help any way that I can, answer your questions, educate my borrowers, prepare them, give them the tidbits on the do's and do nots of the loan process.
Mhm.
I pride myself on being very responsive. So you can give me a phone call, you can shoot me an email. I will be there. My role is to help. Once we get the loan started, I'm going to be there to help satisfy any conditions the lender um, gives us to eventually get your file to final review, working with our processing team, We're going to work hand in hand and together, and we're going to satisfy those conditions and get your file clear to close. I will be there every step of the way. The only time that look, my job is to get that file clear to close. Once I've gotten that file clear to close, boom, my job is it's done. I'll still be here. However, at that point, it's up to the attorneys to figure out what date they're going to schedule everything and do the balancing with the bank. That's not my job. I'm still kind of learning that, but that's what they do. My job is to educate the borrower, get you pre-approved, get you that clear to close. That's exactly what I do.
See, now that's the power of having a great, loan officer. So this way you have the knowledge of what you're doing. And Ricky, you evidently you have the information, you have the knowledge to help people through it. So reach out to Richard Ciuzio. His number is on the banner in front, so don't be afraid to reach out to him. Also, you can find him on our Phoenix National Network app. Once you download that app, you'll see his information on there as well. Go to the website, check out what he's talking about, and get somebody who knows what they're doing on your side. If you're not happy with your current loan officer, give him a call and reach out to find out more information about how Ricky can help you close that deal. So Ricky, thank you so much.
Thank you, Phil. Appreciate you. As always, my pleasure.
This is amazing, man. This is amazing. All right. Take care, everybody. We'll see you next with Karen Mayo, and she'll be on at 12. So see you guys then. Take care, everybody.